Let's now go across to Rohit Agarwal from Kotak Life Insurance. He's with us. Rohit, thanks so much for taking our time for us. Let's start with the markets. What do you make of this listless move? Slow and steadily, we are drifting down. One or the other group is going down. Every day, a big block in a mid-cap stock is coming in. How does market deal with so much supply?
Well, I think the answer lies in the question itself, right? With so much of supply and with so much of macro issues coming up every day, like the events which happened in the US in the last 1 week or so, the market is going to find it difficult to rise in a real manner. And the desperation to exit from the private equity funds tells us that they want to just cash out because they are still sitting on a lot of profits. So the markets after this turbulence will likely go back to what they do best, which is follow earnings. But for the time being, given the turbulence around, they are going to be a pretty patchy ride.
Right, Rohit, this is Vinny joining in the conversation as well, and a good afternoon to you. Obviously, then it's going to be a choppy ride. Then any specific sectors that one should be looking at? And obviously, given the current scenario with the SVB bank, anything in terms of the impact and worry that you are understanding that you're getting from the market?
Well, the impact, if any, is more to do with second or third order derivatives, where none of the Indian banks have any direct linkages with the bank that you mentioned. But it is fair to assume that whenever there is a global issue and there is a global contagion, the effects of that will be felt all across the world because you never know what kind of linkages somebody might have had either on hedges or something else. For all you know, it may impact the flows that flow into emerging markets and India as well. So it may not be a direct impact, but a second order derivative or third order derivative will always be there, where when it spreads, it's fear. And when there is fear, people panic. And when people panic, they tend to sell risk assets. But at the same time, our view is when people panic, one should be courageous to buy because currently, from what we see, it is not an issue which will blow India apart. It is not an issue which will impact the Indian financial system per se. And hence, India, after a little bit of a choppy ride or turbulence, should be all right.
Right. Rohit, you're a fund manager, and it's very easy for you to go out and sell something over there and raise cash. But it's as difficult to hold cash as well. But with select FD rates, select good companies offering about 9%, 10%, does that make you wonder that you should allocate a little more over there? How are you? Because it's the first time in the last 15 years where debt is giving you a significant return that you need to think about.
Well, yes. So if I were an asset allocator, in the current circumstances, not everything may have been allocated to equities. But at the same time, currently I am a 100% equity allocator by design. So my allocation will be 100% to equities. But somebody who has asset allocation to do at this time when times are choppy, it does make sense to have some kind of fixed income in your portfolio, given the kind of returns that you talked about. Either it may not be FDs, but I think some of the corporates do offer pretty decent returns for the kind of credit risk that you may want to take. FDs, even though they might look good, I mean, the post-tax returns are not that wonderful for somebody to get too excited.
Absolutely, Rohit. You said that you're a 100% allocator in equity. Then what are the safe sectors that you're looking at? What are the sectors that you are seeing coming up and where are you looking at right now?
Well, the sectors that we are looking at are cap goods, more driven by private capex and government capex. If you look at the budget, the government has announced the budget where they have increased allocation to capital expenditure. I think one big misnomer in the country today is that they look at headline numbers. But there's also a lot of sea change happening underneath it, where a lot of imports have not been allowed or have been told not to do going forward. What that means is even with the headline growth number of capex of 12%, 14%, or 15%, the underlying growth in some of the companies in India will be very high because it will replace imports. So the impact is double fold. One is that the investment scenario in India is growing at 15% CAGR for the next 5 years, which is higher than the nominal GDP growth. Secondly, a lot of sectors and companies will benefit from less imports or restriction on imports and compulsorily buying from Make in India companies. That itself will give a lot of fillip. there may be a lot of defense companies. There is something to do in pipe companies. There are infra companies who all stand to benefit, not just because of 15% growth headline, but because of restriction on imports and other things. So we are very bullish on the capex theme, make in India theme, China plus one strategy. So the chemicals will form a part of that. Infra companies, some of the pipe companies, some of the defense companies. Basically, we believe that country of 140 billion people, we have taken baby steps into manufacturing, but those baby steps itself will lead to a lot of growth, where growth in these sectors will turn from 5, 7, 8% to 15 to 20% CAGR. That itself is good enough for the next 5 years for us to live with.
Are you worried as a fund manager about the cap goods infra space? Because that seems to be the only space which is a crowded space where people are invested in. I mean, something like a IT, say 18 months back. Are you worried about that valuation, or you think that, it's a completely different sector, and when earnings come led by macro turn, they don't stop in these sectors?
Well, yes and no. In some of the segments within cap goods, we are pretty worried actually, where the valuations are north of 40x, 50x kind of multiples. So in our funds, typically we are not having too many MNC infra names or cap good names, which are trading at 50 times multiples. We are trying to play companies which are more bottom up, where there is a change either in the balance sheet of the company or the prospects of the company itself on top line and bottom line. So it's not a homogeneous thing that we are bullish on all cap goods as a space as a whole. We are selectively bullish on cap goods as a space.
Okay, Rohit, thank you so much for joining in with us this afternoon on Markets at Noon and talking to us about the markets, the sectors as well.